Limited liability companies/LLCs and limited partnerships/LPS. Chapter 1. The LLC to limit business liability. Limit business liability. The following are some ideas to help you limit the possibility of business liability, which comes down to 1. The government trashing you for non-payment of taxes or some other violation of law. 2. Getting in too deep with creditors. 3. Doing something such that people sue you, be it something as simple as mopping your floor and letting people walk across before it dries and someone slips, having a defective product that injures or hurts people, or doing something to purposely deceive people for your profit like price gouging or deceptive company reports. Firstly, think twice about the liabilities of operating without proper licenses and registrations. If you begin to advertise or are fortunate enough to make the news in some way, you will probably hear from a local official. You will pay with embarrassment, time, and money if your business is not properly licensed. Buy insurance. Get a prepaid legal services plan. Have a distinct separation between personal assets and business assets. Use your business truck for work and your car for the home, even if it means you can't deduct it as a business expense on taxes. Keep 2 accounts, one business and one personal. With a sole proprietorship or a partnership, you as the individual and the business are one and the same, which means creditors and litigants can go after your personal assets as well as your business, so incorporating might be a good idea because it separates your personal assets from the business. Rather than get a risky loan with your business as collateral, consider going without it if it could wipe you out should the creditor call it in. Don't be lenient with your customers about payment of their bills to you. Get on them. If they don't pay, cut them off. Bad debts could wipe you out. In order to avoid misunderstandings, second guessing, or somebody trying to rip you off, write out all your policies and make clear written contracts for everything. In your contract, put a clause in saying your maximum potential liability can't exceed a fixed amount like $5,000. If you enter a partnership, include a buy-sell clause that any of you can get out or vote one of you out for a reasonable cash deal should it come to that. If the company is profitable, you can protect the profits by forming what is called a holding company. You could also form a third company called a sister company, which buys all the assets of your main company, owns them and leases them back to the main company such that the main company doesn't own them, therefore has no assets if sued. If you're in a community property state or province where the spouse gets a straight 50% in case of a divorce and you're in a single proprietorship business, an idea is to put your house, car, etc. in your wife's name so they can't touch them if your business is sued. Even in corporations, the directors have some liability risk if they break the law, which can be as simple as a faulty tax return, so the way to protect yourself is don't own any assets in your own name. Have your wife, mother, son, friend own them. Don't have bank accounts full of cash. Either bury the money or set up an account in Canada, Bermuda, etc. Don't make your spouse a business director or corporate director if it means she as well as you will be liable in case the poop hits the fan. Don't keep joint ownership or joint accounts. As far as the law is concerned, it's the same as you owning these things. When you sign a contract, sign it as the authorized representative of the corporation, not as a private citizen for personal use. You can lend money to your corporation and become one of its creditors. Talk to your lawyer about it. Rather than draw a salary from your company, you could hire yourself to it as an independent contractor, a consultant. You could set up 2 companies, your main one and another consultant's company which receives pay from the main for services rendered and is legally separate from it. Have a will or trust so you don't leave a mess if you pass on unexpectedly. Limited liability company/LLC. A limited liability company is very similar to a limited partnership in nature, except that the owners of an LLC are called managers, the owners of an LP are called partners. A limited liability corporation is midway between a corporation and a partnership. It provides protection from personal liabilities like a corporation foes, but it has the tax advantages of a partnership. The company is recognized as a separate trading entity to its owners. Liabilities created by the company need not be underwritten by the personal wealth of the owners. All states conform to the Uniform Limited Liability Company Act/ULCA of 1995, which sets the model for LLCs, but every state has its specific laws regarding LLCs. Think of the limited liability company as a hybrid of a partnership and a corporation. The owners/members have the limited liability that a corporation has but are only taxed once on a personal level. The limited liability company/LLC and the limited liability partnership/LLP are a form of company with two big features. There is limited liability for the loans and lawsuits of the corporation. It is treated by the IRS as a partnership for tax purposes, which means that the business is taxed only once at the member/shareholder level on their personal tax returns and not at the corporate level. The LLC pays no taxes. The individual owners pay taxes when they file their personal tax returns. This is different from the C corporation, which is double taxed, both at the corporate and at the personal level. In 1977, Wyoming was the first state to pass a statute that created the Limited Liability Company, or LLC, in order to help minors attract foreign investors. Now, all 50 states and the District of Columbia have authorized LLCs in their jurisdiction. You form an LLC much like you would form a corporation. You decide whether you will form it in your state or in another state based on the rules specific to every state for LLCs, so you go looking for the best deal for you. Just like the Nevada Corporation is a popular option for incorporation because of all the benefits that go along with it, the Delaware Series LLC is simple to set up and offers multiple LLCs such that people can get a bunch of different LLCs. If someone is in the real estate business, they might get a separate LLC for every building they own. A corporation offers personal liability protection to its owners in case they are sued. Partnerships are simpler, taxed at the personal level as opposed to at the corporate level, and provide better long-term tax advantages than corporations. The limited liability company combines these two features into one business structure, the limited liability aspect of the corporation with the tax advantages of the partnership. Creditors going after an individual owner's shares in an LLC can, at best, get a charging order on his shares and cannot take control of the company or sell it as creditors chasing corporations are allowed to do. With a charging order, they have a judgment of money owed to them that will come out of future profits or the sale of the LLC's assets, but the thing is that the LLC owners can disperse their profits any way they see fit, so they will put the creditor with his charging order at the end of the line and make him wait so long that he agrees to settle for much less than the value of the judgment. Whenever you see a business name ending with LLC as opposed to the Inc. of a corporation, you know it's a limited liability company. S corporations also do pass through taxation, but LLCs are generally preferred because they don't have the limitations that are placed on S corporations. S corporation are limited to 75 or less shareholders who must be individuals, estates, or certain types of trusts, while LLCs can have whoever they want as shareholders/members, including corporations, partnerships, LLCs, and foreign residents, which means they can get foreign investors while S corporations can't. S corporations can have only one class of stock, which limits their financing options. LLCs are not subject to additional partnership tax status qualification requirements as with S corporations. LLCs must simply meet basic partnership tax requirements and not have to be continually vigilant about it in order to keep their status as S corporations must. When an LLC dissolves, it is generally a tax-free event. When an S corporation liquidates, there are taxes based as though the corporation is selling the liquidated assets to the shareholder at their fair market value. An S corporation must keep meticulous records as required by law. LLCs don't have these obligations. If you have to go into liquidation, you do not have to pay any of the debts of the company from your own pocket. The only liabilities which you can be held responsible for are back taxes. The big advantage of the LLC over the limited partnership is that the owners of a LLC have no legal liability personally in the event of a lawsuit, while in a limited partnership, the general partner, S, do. There are two types of LLCs. 1. Member managed, the members make management decisions. 2. Manager managed, the members make only the major decisions like a corporate board of directors and leave the day-to-day management decisions to the managers. LLCs are formed by filing of articles of organization with the State Office of Corporations. They operate under their own written operating agreements. In essence, the limited liability company is a hybrid entity combining the best features of the corporation and the sole proprietorship/partnership. The major advantages the LLC offers its owners are: the limitation of liability of the corporation, the tax benefit of a partnership/sole proprietorship. The owners who are called members are taxed on their personal income taxes. Unlike corporations, they are not considered employees of the corporation. There is a ceiling on personal liability. The managers and members are personally protected from creditors, unlike the general partners in LPS who are personally responsible for the debts of the company. It's much simpler to start and run than a corporation paperwork-wise. The flexibility of ownership. There is no special LLC tax return. You file the same tax form as a partnership, Form 1065, plus your own personal income taxes, Form 1040. All members/owners get a copy of Form K1, a statement of their share of the company's profits which they include as part of their personal income taxes on Schedule E, Form 1040. LLCs are fairly easy to set up with less rules and often lower tax rates than corporations. In most states, one or more people can set up an LLC. Massachusetts is the only state that requires 2 people to set up an LLC. The members of an LLC generally form an operating agreement that establishes how they will run the business. Whereas corporations have limits on the number of shareholders, who also must be U.S. residents, LLCs have no such restrictions. Unless the LLC elects to be taxed as a corporation, it will be taxed as a partnership, which means that the income and deductions of the LLC will be processed by the members through their personal income tax returns. An LLC can have more flexibility in management because its members control it and they don't answer to the Business Corporation Act, BCA, of the state. If one or more of the partners is a U.S. non-resident, or if the managing directors want a management structure that is different from the particular state's Business Corporation Act, then an LLC will give them this flexibility. LLCs can either be managed by the owner, or hired managers. Management comes in 2 forms. By consensus of a majority in interest. By a designated manager. The most common arrangement is for the members to designate a manager. Unlike a partnership, there is no personal liability. All guarantees of loans and other related elements are voluntary. In most cases, for federal tax purposes, an LLC is classified as a partnership. If you're starting a corporation, an LLC might be the best way to go because of tax savings, but if you already have an established Chapter C corporation and want to switch to an LLC, you have to liquidate the corporation, pay capital gains taxes on it, then switch to an LLC. The paperwork for the LLC involves 2 documents. The Articles of Organization. The Operating Agreement. Some disadvantages are: if an owner withdraws or dies, the LLC must be dissolved in some states, but most have an option where they can carry on. The self-employment income the owners pay on in their personal taxes is also subject to Social Security and Medicare taxes. In some states, LLCs can't qualify for certain tax credits and property tax exemptions. LLCs cannot do tax-free reorganizations. Owners pay higher unemployment taxes than officers in corporations do. The LLC works like a partnership on a day-to-day basis. Because it is relatively new, there will be situations that will have to be hammered out in the courts regarding setting precedents for how the LLC will evolve. In an LLC, a member may assign his or her rights of ownership, but not the membership rights. In order to gain membership rights, all of the other members must approve in writing. To find out if the LLC is available in your state, call the SBA, sba.gov, or go to your local office of the Secretary of State. Articles of a Limited Liability Company. The articles of a limited liability company are: name of the LLC, nature of the business, the location and principal place of the business, the name and address of each partner, the term of the partnership including expiration date, The members' election as to how the LLC will be managed. The name and address of the manager. The name and address of the agent for service. The amount of capital and money contributed by each member. Future contributions of the partners. Conditions that the limited partner receives back his investment if at all. Disbursement of profits. The right to admit other partners later. Any priorities given to any partners. A provision for continuing in the event that one partner dies, is disabled, or goes crazy. The right, if any, for the limited partner to take on a more active role in the business. Other requirements may vary from state to state. Operating agreement for LLCs. The operating agreement must contain the following. Operating rules. Rights and privileges of the members. Capital contributions. Profit and loss allocations. Dissolution and assignment clauses. Upon death or resignation of the last member, the LLC will be dissolved and the assets disposed of. By law, the LLC is required to have a definite termination date. Most LLCs are currently being set up for 10 to 20 years. Using an LLC to protect assets. Limited liability companies are useful as both legal protection from lawsuits and for personal privacy. In essence, when you create an LLC for privacy purposes, you use that company as the nominee or the new you for all transactions, mainly vehicle ownership, home ownership, and bank accounts. Keep it as simple as legally possible, which means to form it as a one-member LLC which the IRS treats as a sole proprietorship for tax purposes, which means you file your taxes on your personal tax return as opposed to a special business tax return, so your LLC is essentially invisible to the IRS as long as you don't earn money from it and file it as part of your taxable income. Because nobody's name is on it, some people worry about being questioned on the ownership of a particular LLC. The bottom line is that almost nobody is that nosy, and anyway, possession is 9/10 of the law. The paperwork is in your possession. It's your business, nobody else's. As long as you pay cash or the full amount of a vehicle or piece of real estate, there will be no financing worries where they want to do a credit check on you, so you simply make your LLC the owner as opposed to you. Basically, you set up your LLC in one state, probably Delaware or New Mexico, while stating that the LLC does business where you live, Florida, for example, where you provide an address. It could be your home address if you're not super big on privacy, the address of a mail forwarding service, a fake address, or a friend's address, and you put down its name as the owner when you buy a car or piece of real estate and transfer the title. Take your LLC articles of incorporation down to the DMV. Tell them that you will be doing temporary business in that state for 6 months, the actual state where you live, so you legally have to register the car there even though the business is located in another state. Car registration is the most important thing. Once you have that, you can buy insurance under your own name for the company, which the insurance agent should be familiar with. It's called doing business as /DBA Insurance and looks like this. Joe Blow, DBA Sunny Hills Enterprises, LLC. If you sell the car, it's just like a normal sale. Sign the transfer form in the name of the company. If you're stopped by the cops and they ask what type of business the out-of-state LLC is, just say you do business consulting, helping companies increase profits through expanding trade to world markets. LLC managers and members have limited liability from the debts and lawsuits filed against the company, much like a corporation. However, there are exceptions. In a very few states, one-member LLCs are not protected by the limited liability law. They are responsible for the debts and obligations of the company, similar to the rule that makes the general partner in an LP personally liable for its debts and lawsuit judgments. There is even a rule that this one member must have personal assets equivalent to about 10% of the value of the LLC as a kind of collateral for any debts the company might develop. The way to circumvent this rule is to set up your LLC in a state that doesn't have such rules about personal liability for one-man LLCs, which are most of them. Most states allow the limited liability company to limit the owner's personal liability much like a corporation does. What this means in plain English is that LLC assets are exposed to creditors and lawsuits, but whatever the members and managers own personally, like their homes and cars, is protected by law. The big advantage of the LLC over a corporation is that, in addition to the limited personal liability, you pay less federal tax on profits, and if you are sued or have debts personally away from the LLC, the best these creditors can do is get a charging order against you, which means they have a claim for your percentage ownership of the LLC but can only collect on the profit disbursements this person normally collects, which can be described as payments made on the whims of the manager who decides how to disperse the profits or when the LLC folds. The creditor only gets a guarantee that he will collect his judgment from the profits the debtor earns, but gets no control within the LLC, unlike in a corporation where creditors have rights to take them over and sell them to recover their assets. The charging order only requires that whatever this member is due in profit distributions be paid to the creditor and not to the member. Furthermore, since salaries for work or services, loans, or other compensation beyond profits cannot be seized through the charging order, the manager can still pay the member through one of these methods and bypass the creditor legally. Creditors with charging orders are also in the unfortunate situation where they have to pay the income tax on the judgment regardless of whether they collect the money or not. Because of these two factors, many creditors settle for a much lower sum rather than hold on to their charging order in the hope that they will collect the full sum someday, all the while paying the income's tax on the judgment. A weakness of the LLC is that transfers made to the limited liability company after you have a judgment rendered against you could be grounds for a fraudulent transfer, whereupon the asset would revert back to you personally and the creditor would seize it. If you have an LLC and there is a judgment against it or against you personally, the courts will be more reluctant to go in and try to seize your assets if there are other members besides you as the sole owner. Some states will not grant an LLC to a single individual. You need 2 or more people to start one. Even though many states allow the formation of the professional corporation for professions such as doctor, lawyer, or dentist, they don't allow the formation of LLCs for these professions. Check with your state licensing agency or an attorney to find out the rules in your state. The limited liability company doesn't help with estate taxes in a member's death. The family limited partnership is better for that. In LLCs with several members, you need a unanimous vote to continue the company after the death, retirement, or bankruptcy of a member. This means that any member can choose to be stubborn and ruin the company if he wants to, but the issue is muddled. Whereas the state government may have this requirement, the IRS just requires majority vote to continue the company. Put a stipulation in your Articles of Organization/Operating Agreement requiring only a majority vote to continue the company. The bottom line is that if you want to protect your major assets like your house, a second home, car, boat, etc., put each or pairs of 2 into separate limited liability companies, but consult with an asset protection expert and a tax expert, because there are tax consequences for having some assets in an LLC, like your home, if you sell it. As an individual person, you get a capital gains exclusion but not as an LLC. It's fairly easy to set up multiple LLCs for various assets you own, such as several houses if you are involved in real estate. However, this means extra care in administering all these different LLCs. The Delaware Series LLC is probably the simplest way to do this. You can set up a series of cells within one Delaware LLC, with each cell operating as a distinct LLC. As far as real estate goes, you can't hide the address of the property, so the proposed solution as far as keeping privacy goes, is to form an LLC solely for your house and another for all your other property which will bear a different address. A revocable trust is a legal document that a person can use to buy a piece of real estate property. It is usually applicable until the person dies. I have heard of people who use such a trust along with their LLC, which gives them more flexibility with their property, being able to sell it if they want or divide ownership of it up. The trust owns the LLC. If you want to be super savvy, buy several LLCs, corporations, and trusts with different names and further complicate the soup by transferring ownership of your assets between them. I have read that New Mexico is the best place to set up an LLC for privacy reasons because they have good privacy laws. Even if you live in another state, set up there, then go home and do your car registrations, bank accounts, etc. as that business. Look in magazines like inc.com, sunset.com, or businessweek.com for ads. HowtobeInvisible.com, go to Limited Liability Companies section. llc.com. llcweb.com. LLC websites. Most services that do incorporation can also set up an LLC. These websites are a mix of information about LLCs and LLC incorporation services. 101incorporate.com. alcorp.com. arizona-llc.com. easyarizonallc.com. en.wikipedia.org/wiki/limited_company. en.wikipedia.org/wiki/limited_liability. en.wikipedia.org/wiki/limited_liability_company. en.wikipedia.org/wiki/public_limited_company. limited-liability-net.com. llc.com. llcsexplained.com. llcweb.com. Chapter 2. Limited Partnership/Limited Family Partnership/LP/FLP. Limited Partnership 1. The Uniform Limited Partnership Act/ULPA of 1916 applies in every state except Louisiana. It has been revised in some states and called the Revised Uniform Limited Partnership Act, RULPA. A limited partnership/LP, or Family Limited Partnership/FLP, is a type of business that contains two or more partners. The FLP, despite its name, need not necessarily involve family members. The general partner or partners, are the hands-on bosses who run the show day by day. They are liable for debts and lawsuits. The limited partners have no say in the control of the business. They are investors only who will reap a portion of the profits if and when the business gets profitable. Limited partners do not run the business and have no legal liability for its conduct. They are silent investors who can invest money and enjoy the profits, but if the company gets into trouble, they have no liability even though they will lose their investment. The main reason the limited partnership was formed as a business structure was to allow silent or limited investors in, but at the same time shield them from the personal liability rules of the general partnership. With a limited partnership, a business owner can get money from an investor and the investor doesn't have to worry that the guy will screw it all up, then creditors will sue him for even more money than he invested in the company. A limited partnership requires at least one general partner who operates the business day by day and at least one limited partner who contributes capital but does not manage the business at all and has no liability beyond the investment in the partnership. Limited partners sit back and share the profits. They must not become involved in the operation of the business, otherwise they will lose their limited liability status. It's simple. The general partner runs the business and is personally responsible for its debts. The limited partner does nothing but contribute money and is not personally liable for company debts. Some investors become limited partners for the tax breaks. A limited partnership is made up of at least one general partner and one or more limited partners. The partners can be individuals or corporations. The general partner, can freely transfer their ownership, but limited partners only can if all the partners agree to it. For income tax purposes, all income and expenses are reported on the individual's personal income tax return. From a business point of view, it's wise to make the general partner a corporation that owns just 1% of the partnership. This reduces your liability should you get sued. In general, a limited partnership is formed for a set period of time. It has set rules of governance written out in a limited partnership agreement. Limited partnerships are bound by state and federal securities laws because they raise money from investors. The reason this form of business came into being was to enable general partnerships to raise equity capital from limited partners without giving up control to them. Limited partnerships are complex and governed by many tax and securities regulations. In essence, the advantages are that they're taxed like partnerships at the personal income tax level and have limited liabilities for the limited partners. Venture capitalists should be limited partners but often finagle themselves into full partnership with naive business starters desperate for money, then push them out later. As far as lawsuits go against a limited partnership, plaintiffs can go after the assets of the company as well as the personal assets of the general partner, which means their houses, cars, personal bank accounts, etc. But the limited partners have no liability to any lawsuits against the limited partnership. The way to circumvent this is to make the general partner a legal entity as opposed to you the individual. Simply incorporate as cheaply as you can, which is generally considered to be a Delaware or Nevada corporation, and install that entity as the general partner of the limited partnership. People ask that since incorporating by itself separates them personally from their business dealings within their corporation, why bother setting up a limited partnership and installing yourself as a corporation within its general partner category? The answer is that incorporating in most states is expensive and tedious, requiring lots of paperwork, but if you can incorporate in one of those states with minimal costs and minimal intrusions like Delaware or Nevada and install that legal entity as its general partner, limited partnerships have lots of advantages over running a corporation, such as the following. They are much more inexpensive to start up than a corporation or limited liability company. Initial costs may be roughly equal, but the follow-up administration costs are much higher because you have to constantly provide the government with paperwork for taxes and other things with a corporation. Corporations and LLCs usually have some type of franchise or similar tax in the states in which they do business, as well as an annual fee. Overall, partnership fees are much simpler and lower. Limited partnerships are much simpler in structure and don't have the rules that corporations do. With a partnership, there is no tax on the business itself. Taxes are paid through the partner's personal income taxes. With a corporation, there is double taxation. The corporation is taxed and the individual owners have to declare profits on their personal income taxes. It's easy to add limited partners with new investment money to a limited partnership, whereas in order to do something like this to a corporation, you might have to issue more shares or new shares. Even though the limited partner is an owner, he is out of the management loop, even though he can give advice if he wants to. In order to form a limited partnership, find a specialist attorney through abanit.org who will write up the partnership agreement following all the required government regulations. You have to file for a certificate of limited partnership with your state government Secretary of State office, also called a certificate of organization or a registration statement. Most states have a form for you to fill out, but some don't. They want you to prepare a form and hand it in to them. The certificate has to have the following factors: name and address of the LP, name and address of the general partner, name and address of the resident agent, your lawyer or representative, purpose of or general activities of the LP, mandatory dissolution date. There are other requirement applications depending on the state. Limited partners are generally not named on the certificate. The LP certificate is not a public record. After you get your LP certificate, fill out IRS Form SS4 in order to get an employer's identification number/IN. If applicable, get a tax identification number for state taxes. After you get your IN, start operating as a business with your own bank account, records, etc. A limited liability partnership is a business structure similar to an LP that professionals use, like doctors, lawyers, and dentists. It offers protection to the partners against debts incurred by the practice and claims for negligence and malpractice against any other partner in the LP, but it does not protect the partners from personal claims resulting from their own malpractice. Limited partnership 2. Limited partnerships are business ventures that you can invest in as a silent partner. You check out businesses and put up the venture capital in return for part of the profits. Some people have made it big this way, but most people lose out. These are the type of investments that you might see on an infomercial or in an ad where they invite you to invest $5,000 minimum in oil exploration, wireless cable, or something like that. Here are some resources if you are interested. Limited Partnership for Asset Protection 1. Limited Partnerships or Limited Family Partnerships, Uniform Partnership Act, Uniform Limited Partnership Act, such as being a partner with your wife and children, can greatly reduce federal and state income taxes, inheritance taxes, and can provide good insulation from other liabilities such as lawsuits. The law states that you have the right to either give or sell part of your business to family members just like with anyone else. Generally, there's a main general partner and one or more limited partners. The general partner has the most liability, the limited partners cannot be plundered as equal partners. The managing partner is liable for everything, possibly several general partners who work in the business and one or more silent, limited partners who do not take part in day-to-day activities, are not liable for debts but have rights to the assets and profits. The way to do it is to assign a certain percentage of ownership to each person so you spread it out such that upon the death of the real owner, the business is distributed among several people, thus minimizing estate taxes. A major pitfall is that each partner may be held liable for some of the debt, meaning that if one can't deliver, they can go after the other guys to collect. So the lesson is get good partners, easier said than done. It's also a hassle to dissolve the partnership and divvy up the assets if one of the partners dies. The IRS has successfully challenged the validity of limited and limited family partnerships in court, claiming them to be created solely as a tax dodge. Partners have to have some real involvement in the business. Other creditors are also trying to fight these limited partnerships in court. If you want to form a limited family partnership, make sure to do the proper paperwork and follow the letter of the law. This means that the partners, if general, perform work and if limited, contribute assets or something else to the business, and it's not just a paper ownership. Keep separate bank accounts for each partner. This is also a good alternative to incorporation because you would avoid double taxation but have all the powers to do what you want with the business. For more information, go to your library and ask to see the Uniform Limited Partnership Act. Get good advice from a competent financial expert or an attorney. Consider using Delaware to form your partnership. Limited partnership for asset protection too. From an asset protection point of view, a limited partner is not liable for the debts of the company as long as he doesn't overstep the rules and becomes an active decision maker in the running of the LP. If creditors come after him for an unrelated matter or if they are after the company assets, they cannot go after his holdings in the LP. These holdings are protected by law. The disadvantage of an LP for asset protection purposes is that if you transfer your house to the ownership of the LP, a creditor can argue that the house does not have anything to do with running the business, often called a fraudulent transfer, and the judge can disallow it, making it your own personal property again and subject to your creditors. The best way to use LPS for asset protection is to use separate ones for every little bit of your possessions or dealings. If you're in real estate, make every property you buy the property of one LP, or put some of your personal assets into one LP and spread the rest among several other LPS. This way, if one LP gets sued or runs into legal or business trouble, all your assets are not bunched in there ready to be taken away if a judgment doesn't go your way. An LP can protect your personal assets from creditors and even the IRS and other government agencies if you set it up according to all the rules. Make yourself the general partner, then transfer your assets to it. As far as legally keeping your assets in the United States, the LP is generally considered the best method for safeguarding personal assets in the country. The only disadvantage could be the personal debts and/or judgments against a limited partner. In such a case, a creditor can go after only this limited partner's stake in the company, not any more than this. If the creditor wins a judgment against an LP, he doesn't directly take over a part of the company. He gets a claim for it called a charging order against the LP interest, on which he gets money in the future from future profits and the eventual liquidation of the company. This is a big deal because it shuts the creditor out of the operation of the LP, whereas with a corporation, creditors have the right to force the sale of the corporation or some of its assets in order to recover their debt. Furthermore, since the general partner controls the distribution of profits, he can steer them any way he likes, keeping them out of the creditor's hands long enough for the creditor to lose patience and settle for much less than the initial value of the judgment. Another disadvantage of being an LP creditor with a charging order is that under IRS Revenue Rule 77-137, you owe taxes on that charging order regardless of whether you receive the money or not. The creditor receives the K1 on the reported to the IRS, not the limited partner. Some creditors don't bother getting charging orders and instead try to prove that assets that were transferred into an LP were done so fraudulently. If they can prove this, the asset goes back to its former status as a personal asset, whereupon the creditor makes a claim on it. This is a lot of work though. Only the most determined creditors will pursue this course of action. The LP is pretty good, but ultimate protection only comes from having your stash buried in a safe place somewhere or having it in an offshore account. If you as an individual who is a limited partner in an LP declare bankruptcy, the bankruptcy trustee will only entertain a claim against your share in the company if a creditor gets a charging order against it. If you want to be super keen, have the LP interests owned or held by an offshore asset protection trust. If the LP is threatened, liquidate it. Personal assets held in an LP are liable to less estate taxes upon the death of the owner due to a concept called discounted valuation. Combine trusts with an LP for maximum asset protection, but it's a confusing amount of paperwork with lots of rules, so get an expert to guide you through it. There are several other loopholes to defeat the creditors of LPs that are too tedious to bring up here. Limited partnership brokerage firms. Some limited partnership brokerage firms are Bigelow Management, 420 Lexington Avenue, NYC 10170, 212-697-5880, 800-431-7811. Coiler & Associates, 7373 East Doubletree Ranch Road, Scottsdale, Arizona 85258. 800-833-3360. Equity Resources Group, 14 Story St. Cambridge, Massachusetts 02138. 617-876-4800. Partnership Securities Exchange, 19999 Harrison St. Number 850. Oakland, California 94612. 510-763-5555. Master Limited Partnership Info. A master limited partnership is a limited partnership that is publicly traded on the stock market. It combines the tax benefits of a limited partnership with the ability to raise money by selling stock. allbusiness-planning/business-structures-incorporation/4398112-1.html. bbiworld.com/investment/master-limited-partnerships.htm, how to invest in master limited MLP stocks. LP websites. lpbuyer.com, buys limited partnerships. ilpa.org. Institutional Limited Partners Association, ILPA. mlpassociation.org. MLPA. The Master Limited Partnership Association, MLPA. Chicago Partnership Board, 800-272-6273. cpboard.com. en.wikipedia.org/wiki/limited_partnership. en.wikipedia.org/wiki/limited_liability_partnership. en.wikipedia.org/wiki/limited_liability_partnerships_act_2000. LegalZoom.com, Limited Partnership Law Library. Limited Family Partnership/LFP websites. accounting-center.com/familypartnership.html. alipman.com/snowbirdguide/chap18.html, is a family limited partnership for you? assetprotection.com/family_limited_partnership.html. family-business-experts.com/family-limited-partnerships.html. family-limited-partnership.info.